Hi everyone, welcome back to the Accounting and Tax Helpdesk. My name is Haas and I'm your host this week. This week I'm gonna have a deep dive conversation about the debt and debt management. Debt is simply means borrowing money from the lender, bank, credit union, your family member, whoever that give you money to finance your operation, investment, or expansion. It's very fancy word for a loan, basically. It's the same concept. But a few business owners, actually quite a few, are hesitate to take on debt, and I agree with them sometimes. The first reason is they fear of not be able to make the minimum payments, or they fear there is a bank gonna have a control in the company and they don't want to lose control. And the most important perception is a negative perception. The most important reason is everyone thinks if they take a loan or take a debt, that means failure. But if you use a debt to expansion or to growth and use it wisely, it can be a very powerful tool. As I mentioned earlier, the business owner are scared of taking on debt because of fear of not be able to make the minimum payments, concern about their interest rate, especially if they have a variable interest. Uh, so if in the very inflationary market, the payments might be higher. Uh, they don't want to lose control. Sometimes the bank wants to have a saying in the operation to make sure their money is safe, or if you borrow money from your family member, they might be get involved. So they don't want to lose control, and the negative perception. Everyone thinks if you take on loan or debt, you're failing, which is not true. Different type of loan and debts are basically it goes based on interest rate. So if you get the short-term loan, your interest is higher, but you get immediate cash to help the emergency. There is a long-term loan, which there is a lower interest, which means lower payment, but it's a longer period of payments. It might be more than a year, 5 years, up to 30 years. The best type of loan that I personally like, it's a line of credit. If you have a solid company, you can have a conversation with your banker to give you a line of credit that backed by FDIC. And when you have that line of credit, you don't need to use it right away. But if there is something happen and you need a cash emergency, you can just withdraw from the line of credit. You can, if you are in the factory or manufacturing, you can finance your equipment just like you when you're buying a car, you finance your car. If you have a major equipment that costs a lot, you can use a bank to finance the equipment and pay it over the time. The worst type of the loan is factoring. The factoring means if you giving your AR or account receivable to a factoring company to give you money. That means, let's say if your AR is 100K, the factoring company gonna take your AR as a full price or face value, and they only give you 80,000. And if you take on that factoring, you're gonna be in the loop that it's hard to get out of it. So try to avoid factoring at all costs. But basically, these five loans or five financing option are the most famous one in the market. So let's talk a strategy. Again, debt can be used very if you can use debt in a wisely manner, you can use it to expand your business. For example, you're a restaurant owner and you want to open a second location and you don't have any money. So you can get a loan. Uh, with that loan, open a new location, and with the money that you're making from the new location, you can start repaying the loan. So at the end of the loan, let's say 5 years, you have two locations paid off, and you're a very successful restaurant owner. But again, if you use the loan to expand your business, make sure you have all the projection, all the KPI in place so you don't lose money. And again, if you use the loan wisely and strategically, you can be really successful at the end. As I mentioned in my last few episodes, cash management is very important. So your cash projection is the key on taking on a debt. The sad reality is, bank, they won't give you money when you need money. They always give you money when you have money, which is, there's no point. So, but knowing this sad reality can be very helpful. So you can look at your leading KPIs. Basically, if you look at the market and you think there is going to be a demand in your product and you need to increase your inventory, but you don't have a cash, you can take on loan and buying your inventory. If you think that your one of your equipment are going to be obsolete uh, between the like the next 2 years, you can start getting a loan and replace that equipment. But the most important key is having the cash management, your cash projection in place. So if you have, let's say, 13 weeks, 14 weeks cash projection, at some point you know you're gonna need money, let's say in week 6, but you still have money in your bank. So when you go to the bank, you just say, hey, I want to get a loan. They might give you a loan much easier. But if you wait for a week 6 and you have $0 in your bank account and you go to your banker, the banker, they're gonna reject you very politely. As a business owner, if you want to take on any type of debt, you need to make sure you have four factor in place. First, are you able to make the minimum payments? So, for example, if you're getting a loan to expand your business, make sure your accountant, your CFO, have a projection in place, revenue projection, an accurate revenue projection, so you can make money and pay your minimum payments. The second most important thing is making sure you understand the terms of the loan. The interest rate, is it variable? Is it fixed interest rate? How long is going to be a loan? Are you able to refinance? What's your refinancing period? Make sure you read your contract. The other thing is make sure you consider your debt to equity ratio or maybe the current ratio. The reason I'm saying that, most of the time bankers they put something called uh, loan covenants in place, which means at the end of every month, every quarter, depends on the negotiation, you need to provide your financial to the bank to make sure you meet their loan covenants. That usually is the current ratio, which is your current asset divided by current liability. And they give them, let's say they're gonna say you need to have the 5% current ratio. So when you take on new debts, making sure your debt to equity ratio or current ratio is not gonna change dramatically, because then you're gonna be in trouble. So again, as a business owner or as a CEO, the best time to get the loan is when you don't need the loan. So again, that's a very sad reality, but just accept it. And with that knowledge, you need to make sure you review your cash projection with your CFO every month. If not every month, at least every 2 months. Don't let it go past 3 months and review your cash projection. And with leading KPI, basically knowing what's going to happen in your market sector and what's going to happen in your, if you think the market going to crash and you're not able to collect your account receivable on time, make sure you know that in advance and just don't ignore that. Oh, the market's going to crash, who cares, we're going to be survived. No, there is no luck in business. You need to predict the future as accurate as possible. So with that, if your if your leading indicator shows that you are losing money or losing cash, get the loan. Even though you have money in the bank, but get the loan and making sure you have it. The other point is, if you don't need the money and bank give you money when you don't need this, you can get a much better deal. You can get a lower interest rate, you can get the lower monthly payments, and you can get the fixed rate. If you wait to the end of the deadline and you get your loan, you there are two things gonna happen. And if the bank agrees to give you a loan, they much gonna give you a much higher interest rate. They're gonna give you variable interest rates, and they're gonna put a restricted loan covenant, and you can basically your monthly payments gonna be higher. So you're gonna fall in the loop or not be able to pay the loan, and you're gonna suck in the cash crunch for a while. So if you get the loan and you are not be able to make the minimum payments, or you are not made, you get the variable interest rates, which is a very bad type of interest, or you get a high interest rates. These are the indicator that in the future, in the very short term future, your business gonna suffer because bank gonna put a lien on your assets, and then you cannot do anything. You cannot even sell your asset. If you sell your asset, bank gonna get their portion first. So make sure if you get the loan, make sure get it when you don't need it, so you can get the best rates and negotiate. And going back to my previous topic, the best type of debt is a line of credit. It's gonna be like a credit card. You get it from the bank for $200,000, let's say, and you just park it in your bank account. In your bank statement, it's gonna show up line of credit 200K, and when you don't need, when you need the cash, you just simply transfer it the portion that you need, and you only pay the bank with the interest for that portion. It's not gonna affect you. It's like when you have a credit card, and sometimes you can negotiate with the bank or refinance down the road. So make sure if you're in business in a few years, go to your bank and get a line of credit. And getting a line of credit, just be advised, getting a line of credit, uh, it's easier than getting a loan uh, at the time of urgency. So if the bank gave you the money and you have, let's say, 500K from the bank, uh, make sure you use it very wisely. Basically, with your cash management, you're gonna know how much money you need on a weekly basis or a monthly basis. So if the bank gave you 500K, put it in your money market accounts. Money market account is basically a checking account with a higher interest rate that the bank gonna give you your income, interest income. So, and slowly when you need the money, transfer money from your money market accounts, use it on the operation expansion or whatever you want. So basically, at least you are making some money on the side to help you on the payments. The other thing is, if you are using a loan for a expansion, make sure you are correctly or accurately, as much as you can, predict the revenue projection and your cash income. When you're expanding a business or new location, for sure you're not gonna have a revenue for the next few months until you making sure your customer base are installed in the new location, making sure all your equipment are working. So it's gonna take a few months. Make sure you have a backup plan to make the loan payments. Make sure you are friendly with your banker, uh, so you can negotiate better. If you're gonna be, pardon my French, if you're gonna be asshole to your banker and always send them a angry email when you want to negotiate with them, they're not gonna like it. So try to be friend with your banker. They are good people, so they can be your best friend in the business in the time of need. And if you know your banker, they might give you a loan in the best rates when you need the money actually. So yeah, it's very important. The best piece of advice I can give to any business owner is making sure you have a clear vision of the loan. I give you a very quick real life example. I have a client, they based in Orange County in Southern California. They knew they wanted to sell the company, but they didn't have the money to expand the business. So they got about $1 million, $1.5 million from the bank, they start developing a software. It was a customized software to have a to keep track of all the contractor in the field. They used to be in the construction side business. They knew what they're gonna do, and so we sit together. We create a plan of action. They got the loan. They use the loan based on the plan of action, and 2 years after, they sold the business for $10 million. So if you know want to take a loan, the best piece of advice: make sure you have a clear vision why you are getting a loan. And with that, thank you so much for listening. Please drop a comment, like, subscribe, reach out to us at helpdesk@alamircps.com. We are here to help. See you next week.